Friday morning, good morning. I'm Guy Johnson. Lizzy Burden's here. She's back from Frankfurt. We're an hour away for the opening trade. From the opening trade, what do you need to know this Friday morning? Trump's ex, Elon Musk's epic breakup with the president costs him over $30 billion. We have much to discuss. Washington and Beijing give different readouts on yesterday's Trump-Xi call, with the US signalling a shift on rare earth exports. China, though, didn't even mention them. And the US Treasury calls on the Bank of Japan to hike rates to lift the yen and balance the trade relationship. Lizzy.
A very good morning, Guy. It looks like we're inching towards a nervous start for European equities this Friday morning, down 0.1% for Euro Stoxx 50 futures. But we've got a lot to process before we get to that US jobs numbers later. Of course, we had the Trump-Xi call, as you say, not lifting sentiment much. We also had that surprisingly hawkish ECB meeting. So euro-dollar now at a 114 handle. It had knocked European stocks yesterday. US futures looking to stage a bit of a recovery, but that negative sentiment from the Trump-Musk spat weighing on European futures as well this morning. The countdown to the opening trade starts right now.
I'm very disappointed in Elon. I've helped Elon a lot. Elon and I had a great relationship. I don't know if we're well anymore. I was surprised because you were here. Everybody in this room practically was here as we had a wonderful send-off. He said wonderful things about me.
So, you know, sometimes you sit at a wedding and the conversation around the table is basically, it'll never last. And everybody knows that it'll never last, and ultimately it will break up in an inferno. That's just what we had. Lizzy, I'm trying to think about the right breakup song to kind of put this in context. I think the Miley Cyrus classic Wrecking Ball is springs to mind. We knew this was going to happen. It happened when it happened fast. And it's cost Musk billions of dollars. Yeah,
we are definitely in divorce territory right now. Yep. You know, the world's richest man, the world's most powerful politician having their breakup. It was always going to get ugly. To be fair, Musk said that he's now going to cool tensions with Trump.
Apparently there's a call going to take place today between them. So the White House, that's what's being reported.
But there has been a lot of ugliness in between times. Musk going nuclear. You know, tweeting, posting on X.
Xing. He is an X now.
That the reason that the Epstein files weren't opened was because Trump is in them. The White House declining to comment on that.
It's clearly going to get very ugly. But I think there are actually some real-world implications of this.
Yes, implications.
Market implications, space implications, Tesla implications, like so much of this actually is going to have a real-world consequence. And while we all sit here, like gossip columnists, kind of talking about what is going on between these two and saying, we told you so, this is going to have, I think it's just another distraction. So the market looks at this and goes, what is the cost of this? Mm-hmm. Clearly, we're seeing that in Tesla. Clearly, you're going to see a wider market implication of this. But I think it speaks more broadly of a dysfunctional setup at the heart of the US government and a lack of understanding of what is happening within the White House, a lack of understanding about the rule of law and kind of how the US works and operates. You want to have stability. You want to have a sense of purpose. You want to have a sense of clarity. And we're getting none of that. And this is just emblematic of everything that is happening, I think.
Yeah, if you remove the barbs around the outside and look at the meat of what Musk is actually angry about, Trump says it's the EV subsidies from the Biden era being removed. Musk says he doesn't care. And then Musk is attacking the big, beautiful bill and saying it's a disgusting pork-filled abomination.
But this is exactly. So this goes to the whole idea of, and this will have an implication in the House of Representatives, I think. Will he be able to get it through? Is Musk going to be able to peel off certain members of the House of Representatives on the Republican side?
Who he's funded.
Precisely. So this has political implications. He's talking about setting up another political party. It's amazing to watch, and it's sort of voyeuristic in certain ways to kind of watch these two break up in the way that they are. But it's going to have a real sort of implication. It has a deficit sort of side to it. It has a politics side to it. It has a science and technology. This is really important stuff dressed up as something frivolous. And I think that it almost does take us on, I think, to the Xi-Trump call yesterday. And just, again, the differing views that you get out from the call,
yeah,
which I think is amazing.
To believe. Like, the idea that they've got over the hump of the rare earths dispute, but then you need to see that actually materialising as Beijing agreeing to speed up export licences.
Yeah, the Chinese didn't, in the readout of the call, the Chinese didn't even mention that. And this was why Trump wanted the call, but the Chinese aren't even mentioning it. So are we really on the same page between Beijing and Washington? It doesn't feel like it. I was talking to Val, actually, just before we started the show, Valerie Total, and we were talking about that. She was mentioning the idea that what the market wants to hear is actually confirmation that Trump has been invited to Washington, D.C. And if you get that, maybe that does signal that there could be progress and actually material, concrete progress that you can actually kind of build upon and trade upon. But we don't have it. No, and it's going to take a very long time, even if you do get them meeting, to actually get to a proper trade deal. So, you know, trade experts are saying, given how fast the Geneva Agreement went sour, don't expect much from the next round of talks. Look how long it took to get that Phase 1 deal back in 2020 between the US and China. And it just speaks to this idea that it's proving much harder to get the deals that Trump promised that he would deliver upon. And despite all the talk, it's proving much more difficult to deliver on so many things. Iran, Russia. Ukraine. Russia. Also dealing with all the kind of imperfections of Washington and the spending. So you go back to the Musk story. Musk was brought in to reduce government spending and make government more efficient. Has that really happened? It doesn't look like it at this point. So much of what was promised has not been delivered upon, which I think is fascinating and I think just has to call into question so many of the premises on which the market is currently operating and how believable some of those actually are. So can you trade on those? Can you invest on those? I think the answer at the moment is no. Well, picking up on that theme, of course, we had the Merz-Trump meeting, the German Chancellor Friedrich Merz in the White House. He interestingly kind of let Trump do most of the talking. Wouldn't you? Yes, after I'd watched Zelensky particularly if he's attacking somebody else. Car crashes in the Oval Office. But again, not so much progress made when it comes to Ukraine in terms of those talks. No. So, you know, Trump not directly contradicting him when Merz blamed Putin for the war, trying to get Trump to promise a bit more when it comes to standing up to Putin and talking about a duty to act, but really not that much of a concession made by Trump here. Well, very, very few concessions being made by Trump, and him talking about letting the war continue for a while, which is let amazing them play, to hear. Like toddlers. It's amazing to hear this coming out of the President of the United States' mouth, considering the history of his predecessors and the relationship that has existed. Today, obviously, is a significant day. It is D-Day, the anniversary of D-Day, which obviously I think is worth remembering and thinking about when we talk about that relationship. It does look as if we are tiptoeing towards an arrangement where NATO members are going to push towards that 3.5 plus 1, let's call it 5% target that ultimately many are hoping for. Hegseth has been talking about that. He's going to be talking later on. I'll be fascinated to hear what he has to say a little bit later on the anniversary of D-Day. So we'll see what he has to say. But it does seem as if there is increasing common ground, which is being led by the Germans, as to the idea that actually more does need to be done by the Europeans. Defence stocks rallied on that yesterday. I'm not sure how close they will actually get to 5%. A bit of hesitancy coming from Keir Starmer, obviously, given how fiscally squeezed they are here. And interesting that, you know, the Secretary-General of NATO, Mark Rutte, desperately trying to say this isn't just because we're trying to please Donald Trump. This is because we need to step up defence spending in an era that's somewhere between peace and war. Yeah. And tiptoeing towards the latter, unfortunately. What have we got coming up on the show? Let's talk about the guest that we're going to be talking to. Pooja Kumra, TD Bank Senior UK and European Rate Strategist, joining us shortly. Remember, it is payrolls day. I can't believe we've got through this far into the show without mentioning the fact that it is US payrolls today. Beata Manthi, Citi's Global Equity Strategist, is going to be joining us. Then we are going to be joined by Yanis Stournaras, the Bank of Greece governor. It was the ECB yesterday. Christine Lagarde had lots of interesting things to say. We are going to talk about that with Yanis a little bit later on. And Jakob Aarup-Andersen, Carlsberg CEO, is going to be joining us a little bit later on. Are you going to be having a low, no-alcohol beer a little bit later on? He suspects that you will be, and that is where his business is pushing in a big way right now. We'll figure out exactly what the economics are around low-alcohol beer a little bit later on, Lizzy. Why not just drink water is my question. So Lizzy is firmly in the go to the pub and drink water camp.
It's free.
I'm not sure it's going to last. Yeah, precisely. I'm not sure as an industry, the pub industry certainly in this country would last on that.
Well, looking forward to that conversation as a proud teetotaler. But we've got a lot of other things coming up on the docket as well today. At 10 a.m. UK time, of course, it's the Eurozone GDP numbers. 1:30 p.m. London time, US non-farm payrolls, the big focus for markets, of course. 1:30 p.m. also we get Canada payrolls. And then at midnight, EST, the Fed blackout period begins.
What do you want to talk about? We have to talk about payrolls just for a moment. So I'm looking at the whisper number. So the survey number is 126.
Yeah.
So we're kind of getting into interesting territory now, but 126 is still a decent number, OK? The whisper number is 110. So is the market setting up for mild disappointment here in terms of the way it's positioned?
Well, our economists see 90k for the payrolls number, and that's because they think there's going to be weakness in leisure and hospitality, so even weaker than...
So if you look at the PMI and the ISM data, that would point you in that direction.
Yeah, and they also see unemployment ticking up to 4.3% for May, which is more than the 4.2% hold that the rest of economists see. So basically the story being labour market weakness that we've already seen in some of the other data.
But you listen to people like Kugler talking about the fact that the focus is on inflation. Is it on the labour market? Is the labour market still strong enough? And there's cracks beginning to appear, but is the labour market still strong enough to keep the Fed firmly focused on the inflation narrative and continue basically to wait for the effect of the tariff story to come through into the US economy?
Yeah, traders pricing in that earlier Fed cut in September off the back of the jobless claims rise yesterday. So, yes, we keep an eye, of course, on that data, and we'll talk about it throughout the programme. But I'm very keen to talk to you about the ECB meeting yesterday.
Lizzy was in Frankfurt yesterday.
I was. We thought it was going to be a little bit of a nothing burger, right? But the press conference, much more hawkish than expected. Yeah,
and she signalled the idea that maybe they are coming to an end of the cycle. I think it's been 8 cuts, hasn't it? Mm-hmm. And during that period, would you expected the euro to rally?
But that's not all the euro story, is it? But look, when you look at the scenarios that they published alongside the forecasts to account for all of the uncertainty, they are incredibly optimistic. You know, they don't even take account of the idea that in the worst case scenario that you know, tariffs go back to 50%, or that you have...
Whatever the number is.
They just assume in the most severe scenario that they go to 20%, i.e. the Liberation Day level. If that's severe...
We're about to find out, because the clock is ticking and we're getting awfully close to those dates. So we'll certainly talk about all of this with Stournaras, the Bank of Governor Greece. He's going to be joining us around the table very, very shortly. What else do you need to know? This Friday morning, Harvard University has won a temporary reprieve from President Trump's ban on its international students entering the country. A US district court granted a temporary restraining order saying Harvard would suffer, quote, immediate and irreparable injury if the ban went ahead. A full hearing has been scheduled for later this month. A second moon landing attempt by the Tokyo-based iSpace has failed, this after it lost contact with its spacecraft. It's a substantial blow, of course, to Japan's burgeoning commercial space industry. Executives say the company's Resilience lander didn't decelerate in time, and it was likely that it made a pretty hard landing on the moon. The failure casts a cloud over the firm's next mission, with bosses at the business calling the impact uncertain. Zia Youssef has resigned as chairman of Reform UK, saying he no longer believes it's working to get a Reform government elected is a good use of his time. The departure after just 11 months is a blow for leader Nigel Farage and his insurgent party, which is currently leading the polling in the UK.
You just talked to him, didn't you?
He was here, 10 days ago? I think him and Farage own the party. So it's not like this isn't a kind of owned by members. So I don't know how the breakup there is going to work as well, and how severe that breakup is going to be.
We shall see. But coming up on the programme, the Swiss government publishes a draft law that could have huge implications for banking giant UBS, so we'll look at the details of that. Plus, NATO member states signed off on the military alliance's most ambitious ramp-up since the Cold War, so we'll bring you more on the massive spending push. But up next, it's Jobs Day in the US. We'll bring you more on what to look out for in that key payrolls report. If you've got any questions of your own for our guests, please do send them to us on IB+BB TV Go. This is Bloomberg.
Even in this time of uncertainty, we remain certain and deliberate as ever in our approach. I do. I think so. This is why I am very supportive of the recent decisions from the FOMC to keep the policy rate steady.
We're certainly not doing anything. That's the message from Philadelphia Fed President Pat Harker, talking about where the Fed is right now, which is in a place of uncertainty. But they're certain that they are uncertain. Seems to be the read. Kugler's talking about the idea that inflation actually is the big focus and remains the big focus. All of this obviously ahead of payrolls today. What kind of a number are we going to get? The surveys in the 120s, the whisper numbers in the 110s, Bloomberg Economics is in the 90s, i.e. we're maybe setting up for a slightly weaker than anticipated number. Pooja Kumra, Senior European and UK Rate Strategist at TD Securities, joining us now. The rates market in its totality will be looking at this number today and trying to get a sense of where maybe US rates are going next. Should we be setting up for a weak number? Is that where you think we're going?
I think you can see this weak the macro factors are back on the driving seat, right? We got weaker data, and I think right now if we get a number that's closer to 100, that's a weak data. And if treasuries are sitting in the lower end, the higher end, of the recent ranges, I think it's a pretty good level to be long. For us, 4 to 450 is somewhere we like being long treasuries. Because I think right now what we have seen is only the sentiment indicators being weak. But now they're making their way through the labor. And labor data is something where markets get reactive if they see any weakness.
Does inflation balance out any uncertainty around unemployment? This is the debate that we're having at the moment because we can't quite figure out which one we should be focusing on. Some on the FOMC seem to be looking at what is happening with the labour market. Others are focusing on what the tariff narrative looks like. Kugler's talking about the tariff narrative being her focus and the inflation narrative that goes with it. Does the fact that we've got both of these two forces balancing each other out mean that the Fed continues basically to sit there and do nothing for quite some time?
I think that's the part that we are all struggling with because they have a dual mandate and there's a committee that's divided as to which one they need to focus on. But I think if they see any deviation in the labour market one, that's where you could see Fed more reactive and being more vocal about the fact that, right now policy is bit restrictive. And also if you see even those policy members that talk about tariffs being inflationary, they just call it as a one-time bump rather than an ongoing impact on inflation. So I think if it's hitting the economy, which clearly right now we don't have signs, we have sailed through really well in H1. I think
but are they late? Sorry, are they late with a reaction to an economic downturn because they're worried because that inflation fear, despite it being a one-time hit, holds them back from acting sooner? Normally, by this stage, with the data being where it is, you'd start to hear more messages from the Fed communicating that cuts are coming. It's not there at the moment. So how late is the Fed? And therefore, how big an impact does that have on the downturn when it comes?
I think that's the key thing, right? They will be backward looking. They'll be late to react. And I think that's why, the front end is still pinned right now. Everyone is still trying to keep those two cuts in place because everyone knows this is a Fed that just needs to be on hold till we get clarity on the policy, which is unlikely to come if, everything is on a rolling basis when it comes to tariffs. But I wasn't planning to quote Sheryl Crow, but first cut is the deepest, right? We've all got hit with tariffs.
I'm loving the themes today.
I was quoting Miley Cyrus yesterday. I do not know what's happening this Friday. But Pooja, look, speaking of central banks being on hold until there's more clarity, I was in Frankfurt yesterday. All but the ECB all but declaring victory, right, economically. How did you interpret the meeting? Are you now thinking that that's it, they're done, there's no more cuts to come?
I think it was the ECB meeting the statement was so dovish when it came to the forecast, and there was sudden turnaround to something that we were talking about. I think this was a place where Lagarde had to signal that we are not in a cycle of consecutive cuts. I think it got a bit pushed much more than what markets had thought. I don't think we were actually looking for a July cut. But for me, September still holds, just given the fact, even on the base of their scenarios, inflation still dips below the 2% in 2026. And I think they are very over-optimistic on the fiscal stance also. They are looking at around $120 billion in fiscal coming in the next 2-3 years. And defense fiscals, the general fiscal multipliers are very low, so it cannot create growth suddenly. I think that is something that we also need to keep in mind.
But do you not think that the scenarios were also optimistic when it came to tariffs as well? Because even the severe scenario, I was just saying this, doesn't account for if they go back to 50%, the US tariffs on the EU after July the 9th. Like, what happens if that comes to the euro?
Yeah, no, like growth, I think they just thought that the first half of the year growth has been resilient. Europe is resilient. And to be honest, Europe has been much more resilient as compared to what all of us thought. We did have a 0.3% growth, but I think it was all the front loading. I think ECB still maintains the narrative that saving rates will go down, real disposable income will increase, but we've not seen that in the last 5 years. So to your point, they are being very optimistic, and I don't consider that fiscal to show up in the growth data that soon.
The US Treasury is calling on the Bank of Japan to hike rates. Maybe it will, maybe it won't. We'll wait and see what foreign influence has on the Bank of Japan. But Japan is becoming more and more interesting from a global perspective because of the issuance issue and how it manages that issuance story, how the Ministry of Finance manages in that issuance story. What is your current thinking on whether or not the market is, at what price the market is going to be willing to take down all of the paper that is coming at the moment? And where does the burden fall? Is it in the US? Is it in Japan? Is it in Europe? Where do you think the biggest impact is going to be felt?
That's a very good question. And I think that is something, I get asked, what is Trump looking at? What is Besant looking at? Whether it's curves, stocks. And I'm looking at what central banks are looking at right now. And that's the long end of the curve. Because any long end move is actually tightening financial conditions, right? And if you see in terms of Japan's 530s curve is actually 200 basis points. It seems unrealistic. So we are watching each and every auction, and we saw this week's 30-year auction was extremely weak. I think there's a very big probability that, Japan has to look at either tweaking their QT buckets or actually reducing issuance. And I think that is the case for UK as well. And I think I do actually like parking money in the long end of the curve, just because, if you do see that cutting cycle starting in UK or in US, where does the money market funds go? You need yield. You just go out of the curve because everyone is scared to issue long end paper right now.
And in that same Forex report from the US Treasury that Guy was mentioning, where they were calling for the BOJ to hike rates to strengthen the yen, they also said that there weren't any currency manipulators, but basically we're looking at you, China, because you've got this lack of transparency. How much do you think that in the trade war you're going to have FX figuring more alongside tariffs as a front?
That's a great question and very hard to answer right now because the FX has been at levels that we have not seen ever. I think still it's basically, we can see that tariffs are playing a major role when it comes to the FX. And it's less about the policy right now, right? Even if you look at Euro USD as well as yen. For me right now, is this FX move is just because all the parties here were underhedged. Like Euro USD, these levels are not because suddenly we are very optimistic about European growth. It's more about all the asset managers who held USD assets never thought Euro USD will be at these levels. So for me, the first thing is that is this trade just about hedging cost, or is it something that we are actually de-dollarization?
Yeah.
Now, if you have more talks about the Section 889 and taxes and all, the trade could continue. But otherwise, I think this could be a very short-lived move on currency.
Rutte, Senior European UK rate strategist over at TD Securities. Good to see you this morning. We thank you. Up next, Merz and Trump's meeting in the Oval Office. We'll discuss the details next. This is Bloomberg. "30 minutes from the start of the opening trade, and European futures are pointing a touch lower, so kind of catching up to the negativity at the end of yesterday's US session, given that Trump-Musk spat. And if we look over to your bond space as well, yesterday you saw the action, the short-term bond yields jumping to a 2-week high off the back of that hawkish ECB presser. But looking at it now, it's a pretty steady picture across the European bond space this morning, Guy.
We are waiting for payrolls. I think that seems to be the message coming out of the markets loud and clear this morning. Let's talk about another aspect to the political developments that we've seen over the last 24 hours. The German Chancellor, Friedrich Merz, successfully navigating a meeting with President Trump in the Oval Office. Didn't fall victim to the public humiliations that we've seen the American president doling out to other leaders. Did he make any progress, though? I don't know. Define a successful meeting with President Trump. Merz's meeting comes as NATO member states signed off on the military alliance's most ambitious build-up since the Cold War.
We agreed on an ambitious new set of capability targets, and this is so important. These targets describe exactly what capabilities allies need to invest in over the coming years. Air defense, fighter jets, tanks, drones, personnel, logistics, and so much more. All of this is needed to keep our deterrence and defense strong and our 1 billion people safe.
And Germany has a lot of catching up to do, but it's certainly beginning to put its money where its mouth is on that front. Let's talk about the meeting at the White House yesterday, and then we'll talk a little bit more about what's happening with the defence story in more detail. Germany's bureau chief, Christoph Rauwald, joining us now to talk about all of this. Christoph, nice to see you on the show. What defines a successful meeting with President Trump? Is it escaping unscathed and not being dressed down by the US president, or is it actually making progress? Because I wonder how much progress was actually made yesterday. This meeting is being seen as a success because he didn't get hit by the president. But did Friedrich Merz make any progress yesterday, particularly when it comes to trade and some of these really important issues?
Yeah, good morning, Guy. I think he definitely made some progress when it comes to establishing sort of communication channels with the White House, like getting a direct line into the White House. It was his first visit and his first direct conversation with Donald Trump yesterday. So in terms of like getting on a speaking level, on speaking terms, a direct line into the White House has been, I think, successfully achieved yesterday by Friedrich Merz. But I think it would be I think it would be very difficult to basically conclude from that any meaningful progress has been achieved in other areas like tariffs, like defense spending. I mean, they went for lunch yesterday after the Oval Office meeting. We are still sort of like chasing what the readout of these conversations has been. We have no indication so far that any meaningful concrete agreements have been reached. But that is something that would probably be easier going forward than it had been before the meeting yesterday, where it was still unclear how good or not so good, like the two men will actually get along.
Well, so you mentioned defence. What are we likely to see in terms of NATO members trying to muster this 5% of GDP spending on defence? That's what Trump wants, but is that realistic for the other members? You had that meeting of the NATO defence ministers in Brussels yesterday.
That is the big question ahead of the NATO summit in The Hague later this month. Germany has made a pretty significant commitment with a very sweeping fiscal reform that allows essentially unlimited defense spending in coming years. They basically excluded spending for defense from their fiscal budget, and so they have a lot of like fiscal leeway to boost up or basically to boost the defense spending. As Guy, as you mentioned already, they have a lot of catching up to do. The German army is in a pretty poor state, but it still remains to be seen how that sort of defense build-up can be achieved across all NATO members. Some European countries have been much more reluctant, basically, and not all of the NATO members have the same sort of financial leeway to also really boost defense spending as it's been stipulated under the 5% goal.
OK, Christoph Rauwald, our Germany bureau chief, we thank you for the latest on that meeting in the Oval Office. Now, Elon Musk has signalled that he will move to cool those tensions with the US President Donald Trump after the very public unravelling of their bromance. The two attacked each other from their social media platforms with explosive claims over issues both big and trivial. Musk went as far as agreeing with an X post that called for Trump's impeachment, and the president in turn hinted that he may have to terminate US government contracts that have been given to Musk's companies worth billions of dollars.
I've always liked Elon, and I was very surprised. You saw the words he had for me, the words of, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about 1.6 trillion in cuts.
Bloomberg senior editor Bill Ferries joins us now. Bill, you've got a lot of Republicans desperate for them to kiss and make up. Do you think they can?
Yeah, I mean, we're already seeing the signs of some of that unfolding. Politico actually reporting that there's been an attempt to get a call made between at least senior White House staff and Elon Musk. And, you know, if that goes well, perhaps even get Donald Trump on the phone, I suppose. I mean, I think everyone was taken by surprise at the rapid meltdown that unfolded, particularly during that Oval Office meeting between Trump and the German chancellor, with Elon Musk kind of live tweeting his responses to the criticism Trump was giving in the Oval Office. We knew there was some sort of a breach between the two earlier in the week, as Musk seemed to become frustrated that the electric vehicle tax or rebate wasn't included in that big, beautiful bill that Donald Trump has spent so much time working on. But I don't think anybody expected it to erupt into that real food fight that we saw in the Oval Office. So both sides are sounding a little more level-headed, like they want to get things back on track. And it is, frankly, really important for both sides that they find a way to do that.
It still amuses me that Musk has decided to call Twitter X, as he is now one. But there are real-world implications of this, aren't there, Bill? And let's talk about those. The big, beautiful bill is obviously potentially a casualty of this, but it goes beyond that. There are real-world implications, regulation, what happens in terms of political funding. This is important, and I'm wondering whether or not it does show up in the ability of the Trump administration to push through the big, beautiful bill. Are we going to see it derailed?
Well, you know, it's already been not on life support exactly, but it has always had a difficult road ahead of it. As soon as it passed the House, you had Republican senators criticizing different aspects of it. Some of them want to see bigger spending cuts, and some of them want to see those changes to Medicaid reversed because they don't want to see people losing access to health care. So it always had a fraught future ahead of it. The Republicans can only afford to lose 3 votes in the Senate. If they change the bill, which they very likely will, it goes back to the House, where there's really a very similarly small margin there. So this is Donald Trump's signature legislation. It's almost his only policy priority. And as he mentioned there, you know, his 2017 tax cuts all expire this year. He's got to get that passed to secure his legacy and his priorities. So it's also bad for Elon Musk's brand and his companies to be engaging in this back and forth. But really, listen, Elon Musk was the single biggest funder of Donald Trump's campaign. He spent $290 million on it. He basically lived in Pennsylvania to help deliver that state. The Republicans are just over a year out from another election. They would love to have the world's richest man behind them in that fight. So there's a lot of kind of long-term issues at stake here, along with whatever happens in the next week or two with the big, beautiful bill.
Yep. Some counselling may be required. Bill, thank you very much indeed. Bill Ferries joining us on the breakup between these two important men. Coming up, the US Treasury wants the Bank of Japan to hike rates. We'll dig into that unusual call. That's coming up next. This is Bloomberg. 17 minutes to go until the opening trade. Let me just tell you that sneakers and sweatpants are going to be the big story when we get to the market open in just a few minutes' time. You are agog with anticipation, I know, but you're going to have to wait to find out why. Something to do with Lululemon. Let's talk a little bit about what is happening, though, in the macro world, top down, not bottom up. Let's talk about what we're getting from the US Treasury and its requests that the Bank of Japan raise rates. Valerie Teitel joins us to discuss. Is this sort of a little odd?
The Mar-a-Lago Accord in action, perhaps? Maybe. But yes, this was the biannual report from the U.S. Treasury on foreign countries' currency trade practices. And the first one that Scott Bessent has written. And it did have a very direct shot at the Bank of Japan, saying policy tightening should continue to proceed in order to help prevent the yen weakness and their export-driven economy, which clearly the Trump administration wants to turn around.
OK, shots fired from the Treasury. Bloomberg's Valerie Teitel will stay with us around the table, but let's bring in our MLive guest now, our MLive Market Minute in 3 minutes. Joining us now is our Bloomberg FX and rates reporter, Ruth Carson. I want to turn to the jobs report, Ruth. We've got payrolls looming. What is ultra-long bond price action signalling to global markets this week?
Absolutely. Ultra-long bonds, all in focus, regardless of whether you're in Tokyo, New York or Sydney. It's all about it this week. Auctions that have been facing lackluster demand. And yes, bond traders are definitely on edge. You've got a major print coming out here with payrolls. Everyone knows how important they are to get for a pulse of the US economy. And rates traders are also grappling with this lackluster demand for anything beyond 20 to 30 years. I mean, look at Japan. Yesterday, they had a 30-year auction, and that drew the weakest demand ratio since 2023. Just a day before that, yes, South Korea, you had Australia, same thing, multi-year lows in terms of demand. The bond vigilantes are definitely out in force here, really testing the waters, going, just how much debt are you willing to issue before we come back to bite you? And you know what? Everyone on the street that I'm speaking with, traders, economists, strategists, fund managers are really questioning this. So definitely want to watch out. And because of the data that's coming out, it could really, really impact how investors view and traders price Fed policy going forward.
Ruth, I was in New Delhi earlier on this week, and I think it's quite sad that I was excited that I've actually been outside the Bank of India. RBI, I've been there, I've seen it, it was quite exciting. I think only a financial journalist could be excited by that. But it is exciting. It delivered a 50 basis point cut. There you go. My excitement was justified. Absolutely. How exciting was it?
Oh, absolutely. That literally came out of nowhere. Just to put things into perspective, only one strategist, one economist actually called for a 50 basis point cut. So that definitely came out of nowhere. The vote was 5-1 for 50. And interestingly, what people are zeroing on is obviously the language that is used by the RBI and the fact that they have turned neutral. They're in a neutral policy stance now. People are taking it as, you know what? This is it. They're done. They're front-loading. They're front-loading the cuts. They're definitely trying to, whoosh liquidity into the system to shore up the economy. And considering you've got the trade war going on, you've got worries about inflation around, and also all these bond shenanigans that we're seeing in markets, it's no surprise here that, in a way, people are just really digesting what they're doing and seeing it as a hawkish cut in a way.
Ruth, just take us through the market reaction to that Trump-Musk clash in Asia.
Oh, look, absolutely. We woke up, the whole world saw from Tokyo through to Australia about, this massive clash that's going on. Definitely watch Tesla today. Everyone is on edge.
Ruth, thank you very much indeed. Great stuff. Our FX and rates reporter, Ruth Carlson. Everybody's interested in what is happening with Tesla stock today and what's going to happen. Are we going to see a make-up or are we going to see a continuing breakup? Let's carry on the conversation and figure out what is going to be moving things at the open this morning. Sagarika, Jason Ghani and our very own Valerie Teitel are still with us around the table. Nice to see you this morning.
Pleasure to be here.
So I'm told that we need to be focusing on sneakers, sweatpants. Lululemon is going to be the story of the morning. Have I missed something here? Is that where I should be putting my attention?
Look, for stock markets today, earnings, company reports, always important, but I think the main focus of the day today is going to be jobs. We can't get away from talking about that guy. There's been a shift in sentiment recently from being very jittery related to trade to suddenly there's this optimism that the US economy is actually chugging along. Investors have started to show a little bit more resilience to knee-jerk reactions. They're staying away from knee-jerk reactions to trade. There is a risk, of course, of things getting too complacent on that side. But today, square and center is the jobs report. There's been a bit of mixed data that we've seen on the labor market earlier this week. So, stock markets, again, have a way of positioning themselves as a win-win point of view. So if it's a stronger than expected report, then, of course, good data is good news. That means the economy is strong. On the other hand, if it's a weaker than expected report, then investors tend to view that as, well, that means a higher odds of a Fed rate cut, which is also good news for the stock market. So it could go either way. But I was looking at some numbers from the team over at JP Morgan. They gamed out scenarios of what stocks could do in terms of in reaction to the report. And they said, if it is a much softer than expected report, and the number they put on it was fewer than 100,000 new jobs, then they see the risk of a sell-off of up to 3% in the S&P 500 today.
Wow. And sweatpants are important.
Very important, Guy. I want to talk a little bit about Section 899 and what that means for European equities. So perhaps another U.S. catalyst causing some reaction to European companies here. What have you been hearing from European companies? Are they worried about this?
There's been more concern in the last week. Naturally, there's questions rather than worries. We've talked to asset managers about, are you moving money based on this right now? And the short answer is not really, but it's on the radar. We've had some strategists started to come out and forecast what this could, the potential implications could be for European stocks. There are companies in the benchmark stock 600 that would be exposed to this should it go through. But that's the key question right now, is this another negotiating tactic? At what point does it go through? What form does it take? We don't quite know that. Goldman Sachs strategists had a note out earlier this week, and they said, the risk is actually quite manageable right now, because even if it goes through as proposed, then they only see that reducing stock 600 earnings by about 5% over a 4-year horizon. So not alarm bells quite yet, but one to watch.
Sagarika, we're always talking about, when the positivity is going to stop for the S&P. Like, when's the reckoning coming? Is it the summer when you've got less liquidity and Wall Street's on holiday?
I think so. I think there have been some concerns about that recently, some questions again. We saw that big bounce in May, both in Europe and the US over since the lows in April. So there were questions about, has positioning gone up again? The interesting part of the rally is that it has been driven more by retail investors. So institutional, the big money, the smart money, is still quite underexposed to equities. All of that means that the path of least resistance over the coming weeks is still higher, but then that leads into the summer volatility that you mentioned, because that's when liquidity dries up. We had the big sort of growth shock in August last year. That was over the summer. In 2023 as well, we had a slight pullback in the S&P 500 again over the summer. So we could be heading that way again.
But the bigger picture here is that we don't know. We don't know what payrolls are going to look like later today. We could get a surprise. It could be a downside surprise. I think actually the Lululemon stuff is important because it tells you something about what's happening with the tariff narrative. The stock's going to get hit pretty hard today. There are indications there that there are things happening behind the scenes that the market's yet to catch up to. But the market seems to be positioned for it's going to be okay. Don't worry about this. Nothing to see here. The US economy is going to power through. But more and more evidence is suggesting that that's to the contrary. To Lizzy's point about what happens this summer.
Look, the equity market rebound, a lot of that has been done by this reaction because the soft survey data was a disaster. But we didn't get any confirmation in the hard data. And the longer we don't get that confirmation I think the longer it goes that the U.S. equity market can rally, the dollar can weaken. All of these things combined can continue in the absence of any bad hard data.
Yeah, but you had that not so great trade data, right? And surely that shows that the front loading's over. You had warehouses full, maybe they're empty, and once you get rid of the inventory that was in there, now you've got to pay tariffs. Do you have to raise prices? Like, it's coming, isn't it?
Those are very fair questions. We don't know whether this front-loading of activity is really going to drag on the rest of the year. But look, the U.S. economy has proven itself to be resilient before. We have the Fed currently on the sidelines. Maybe today the kind of Goldilocks number is something slightly soft that will pull that Fed cut a bit forward. That would help the equity market, maybe help the S&P 500 end in bull market territory today. We don't want a disaster number, but maybe a slight softening of hard data would be welcomed by the equity market.
Bad news, good news.
Okay. We'll talk about kind of how that is represented through the lens of Lululemon in just a moment. Sagarika, thank you very much indeed. Nice to see you. Thanks for joining us around the table. We should do this again, which will be great. But I give you Exhibit A, which is Lululemon, OK? So there is going to be an effect today in Adidas. There is going to be an effect today in Cuba.
And it's all just because people aren't wearing tight leggings anymore. It's the baggy pants trend is back. OK,
so there's a fashion way of thinking about this, but there's also a tariff way of thinking about this. They are saying that basically tariffs are causing the problems. They're also saying they're going to have to raise prices, which is why the Fed is still worried about what the inflationary impact of all of this is going to be. It has yet to show up, but Lululemon is a brand that we all know and love, and it is saying that it is going to raise prices.
Yeah, look, I still think that there is going to be more upside in the next earnings season. We've had all this tariff delay going on, all these companies scrapping guidance. I mean, I think we're just setting ourselves up for a better than expected earnings season the next time around, and I think that can really help at least risk over the summer.
What takes away? What's the risk to the risk story that you're talking about?
Oh, is that the hard data turns? We get an unexpected rise in the unemployment rate, one that the Fed, I guess, forgets the inflation side of the mandate.
But the market seems to be putting its fingers in its ears and going, la, 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 I don't want to hear that. I don't want to run that risk. At the moment, it's like everything's going to be great. Why isn't the equity market taking on more hedges around all of this? Why is the equity market not?
Because the expectation, the bearishness back in April got so bad. I mean, we're just reacting to that unwinding.
I hate to break it up. Bears and bulls, we're coming up to the opening trade. Stay with us. This is Bloomberg.
The 6th of June, important things were happening 81 years ago. We'll talk about that a little bit later. But we've got a few minutes to go until the opening trade. Let's talk about yesterday's session, and then we can talk a little bit about what we're seeing in futures this morning. We rolled over after the European markets had closed. So just factor that into your thinking first thing this morning. We went out here near session highs, actually, for US markets. We then definitely rolled over as the day progressed, as the Elon Feud gathered pace, the Elon-Trump feud gathered pace. We watched markets roll over. Tesla also got hit pretty hard. We've also got the Lululemon story to fold into our thinking as well. Watch how that affects the German trade first thing this morning. Let's talk about what futures are signaling first thing this morning as we head into the Friday session. We are, of course, awaiting payrolls. That's going to be the big story later on. But at the moment, we are very becalmed. Euro stocks not doing anything. FTSE futures not doing anything. DAX futures not doing anything. We've got a few single stocks that we do need to talk about. There will be a read across into the athleisure sector first thing this morning, but it's really about what is happening with payrolls a little bit later on that will ultimately determine this session. What kind of a number we get will be important later on, Lizzy. What are we seeing, though, in terms of those single stocks?
Well, let's get to your fave, Lululemon. So it cut its outlook, but we have to keep an eye on the read across to the likes of Adidas, Puma, JD Sports in the European session. Lulu fell as much as 23% in extended trading in New York, so let's keep an eye on what happens in Europe this morning. We also have the news that HSBC's chairman, Mark Tucker, is going to leave at the end of September, so we keep an eye on those shares as well. And just finally, Siemens Energy on course to pay its first dividend in around 4 years after replacing their German rescue package. So watch Siemens Energy as well, Guy.
In theory, it should be a quietish open, Lizzy. In theory, we should get everything kind of up and running fairly quickly. We'll see whether the German trade's a little bit more interesting and maybe actually things get held up a little bit there. But we are expecting a fairly flattish open. So here we go. Time for the opening trade. Let's see what we get out of the FTSE 100 first of all. It is delivering as anticipated. Barely a budge from the FTSE 100. We are seeing not much movement already. We don't even see anything yet from the Stock 600. There it is. A staggering move to the downside of less than 1/10 of 1%. The IBEX is down less than 1/10 of 1% as well. We'll wait and see what happens with the CAC and the DAX. Be interesting to see how long it takes. Potentially you could see an effect into Adidas today, but maybe actually the German market isn't seeing much action. It's open early by its standards. The CAC Current is up by less than 1/10 of 1%. The German market is as flat as a pancake this morning. Lizzy, provide some excitement from the sector point of view.
Well, I wonder whether everyone just needs to wake up or they're just holding their breath until that jobs report. But if we break it down by sector, you've got just under half in the green. Energy's leading the gains. It's up 0.25%. You've got utilities up as well, real estate, healthcare. But at the bottom of the basket, it's basic resources. So they're down 0.7%. Autos and parts not far behind. And then consumer products and services also down 0.5%. So if we dive into some of those names that we thought might be affected by the Lululemon drop, you've got Adidas down 0.6%. 0.5%. Puma down 1.25%. So there we could see that reading into the DAX more broadly. And JD Sports down 0.5%. I mentioned HSBC because their chairman's going, Mark Tucker. HSBC actually flat to the upside. And Siemens Energy is up 0.5%. So I'd mentioned their dividend. Traders liking that.
It's not exactly a big move from Lululemon, though, is there? These aren't dramatic drops that we're seeing in the athleisure sector first thing this morning.
But as you say, it's more to the macro story and seeing, you know, the impact of tariffs and the hints of how it'll show up. You know, we talk about the job story, we see the job cuts at Microsoft and Disney. This is just the hints of further what's to come. It's
interesting that actually the luxury sector is under pressure. So we're seeing you've got Merz down this morning, you've got LVMH down this morning. So actually there is some weakness in that space. You do have the pharma sector doing a little bit better, so maybe a sort of seeking of safety within that space too. So we'll just keep an eye on exactly what is happening from a sector breakdown point of view. But broadly, the market is going nowhere. In terms of the stocks we've got on the Stock 600, 234 up and 270 down. 79 are unchanged. Nothing to see here.
Let's make this Friday more exciting, shall we? We've got Beata Manthi, who's European Equity Strategy Head over at Citi. She joins us around the table. Beata, I want to go back to the ECB yesterday. I was in Frankfurt. You had this surprisingly hawkish press conference, right? Surprising the market, knocking European stocks. If you don't see another cut from the ECB this year, how much is that going to knock European equities by the end of the year?
The market didn't love this rhetoric, right? I think it's knocked off almost 1% of the stocks from the highs on the day. And at the end of the day, well, the cuts from the ECB have been underpinning the equity market, but it was one of the factors. It's not the only factor, right? So let's assume they stop now. The question is, why do they stop? This is crucial, right? Because there were some bad rhetoric, but also some good rhetoric about surprising resilience and potential for GDP growth to recover. Still lots of uncertainty. A lot depends on what is going to happen on the trade front and negotiations. But historically, we've been looking at what happens to equity markets in the environment when rates are, well, long end is going higher, which this is what you would expect to do as the result. And really, the only differentiating factor whether equities would go up or down from these levels was what the economy, what the PMIs were doing. So no matter the level of rates, no matter the level of inflation, if PMIs were picking up and inflation was curbed, was no longer going up or was going down, this was a bull signal for equities. Now, if in turn we have stable inflation and growth is going down, it's going to be a problem, right?
OK, so focus more on the data than reading it as a response to the tariff uncertainty. Don't see it as a wait-and-see approach. See it more as the ECB declaring victory. OK, that's interesting. But then also you need to factor in, of course, the euro impact, right? And, you know, if you have a stronger euro, as we heard the ECB talking about pursuing, not just from Lagarde, but from Panetta as well, how much more of a headwind does that create for European earnings growth through the rest of the year?
So for us, given the research that we've done, for every 10% move in the currency, you get around 2 percentage point hit on the EPS. But for European equities, it is more nuanced than that. It's not just bad, right? When you look at the exposure, revenue exposure of European equities, it's 50-50. 50 is domestic, 50 is international. So our review is you should be going for domestics right now. Euro strength would help that part and has been already. And of course, being more longer term, you should think about what the stimulus is going to do and which parts of the equity market, of the corporate, it's going to affect the most in a positive way. And of course, it is domestics, right? So it's 50-50. Some regions in the world have a very strong relationship with the direction of the currency. UK, for example, but for the European index, it's more treacherous. But also, last point that I wanted to make about the direction of the dollar and of the euro. It really makes a difference when it comes to asset allocators. So from the global perspective or from the US investors' perspective, historically, when you have US dollar weakness, you see more reasons to diversify away from the US, right? So we see another 5% on euro stronger by the end of the year, and we think it could be just another reason, among many others, to diversify a bit more into the rest of the world. How
permanent is that shift? How permanent is the decision by allocators? It started here in Europe, but it'd be interesting to see whether it shifts to the United States to move money out of the United States. Is the era of the last 15 years over? Can I categorically say this at this point?
There are tentative signs that it could be over, but I feel many investors push back against that, right? Many feel that we are going to back. There are no reasons to believe that we are going to go back, not going to go back to what we've been used to over the last 15 years. And that was the world with no inflation, no rates, and no growth, or weak growth, right? Why Europe could not outperform meaningfully in that environment? Because of the setup, the composition of the index, right? So it's very cyclical and it's very financial. Low inflation, big headwind for cyclicality. Zero rates, big headwind for banks. It was an impossibility for Europe to do well. Now, you've got to believe that inflation will stay with us, which are many reasons to believe that this is going to be the case. And with that should come the rate cycle, right? So what the ECB is saying is not necessarily as bad for equities as one could believe straight away. But what we need to make the good equation for equities over the longer term, European equities, is really growth. And this is where the stimulus should come in, right? It was always going to be backloaded. We wouldn't see the growth this or for most of next year. But there is a steady revenue stream and commitment for that to come.
At a kind of index level, at a top-down macro, from a top-down macro point of view, do you think equity investors are being properly compensated for the risks they're running in terms of the global economy, a downdraft, I don't know what the risk could be, a crack in the financial system. Do you think we're being compensated for that right now?
The question is, what risk are we talking about, right? Crack in the financial system
but there are
sounds
so many.
Like a big deal.
But are the left-side tail risks, are equity markets being correctly pricing left-side tail risks? Are equity investors being compensated for the plethora of risks that now sit out there that are higher than normal, it seems?
So equity risk premia around the world have been going up. Right? In Europe, they are relatively high. In the US, they are still low. What we've been arguing, of course, you could have the situation that they have to go even higher, right? But if we get a trade deal and if we avoid recession or bigger slowdown, it's a lot about ifs, right? The uncertainty really weighs on the sentiment right now. But if that's the case, you could imagine, and we haven't mentioned the bill and the Section 899 and many other issues, right? And the direction of the dollar. You could believe there will be a set of circumstances going forward that would make ERP in the US slightly higher. I'm not talking big numbers, but you could have a compression, right? So if indeed going forward, not today, but over the next year or so, you have more reasons, investors start to believe that the reasons to come to Europe exist, i.e. the growth will be eventually higher, then you could see the compression of ERP in Europe, and the diversification could mean that the ERP in the US could go slightly higher. How about that?
We could go back to 899, but you talk about the stimulus, the fiscal stimulus. When you look at the defence names, and some of them a bit up today, Rheinmetall up 0.1%, how much more can be squeezed out of them when we just don't have any concrete plans really on this? We don't know if everyone's going to spend 5% of GDP on defence yet. If that doesn't come through, is there much to squeeze left out of the defence names?
So when it comes to defence names, you could have asked me the same question at each of the previous rallies, and probably everybody would tell you, well, they've rallied a lot, they price a lot of this future growth, right?
Sometimes you've got to sell a rally, right?
Sometimes you do, but defence stocks have a new paradigm, right? When you ask our analysts, they would tell you the next 5 years' growth is already in the price. But what we found historically, when you have a new paradigm, stocks re-rate, right? Because
but there's so many risks. Could there be a windfall tax? What would a windfall tax? So the Germans are already talking about a windfall tax on defence names. because of the amount of money that's going towards them.
Of course. But you have to counter it with the amount of capex that is first needed to get this revenue stream, right? So the companies need to be convinced that that commitment will yield. And so perhaps further down the road we'll have these conversations. But what is certain, 3% is certain, right? There is this revenue stream, and when you talk to our economists, they would tell you it's not only the next 4 to 5 years, it's much more to go, right? If we really go for submarines and so on, it takes a very long capex cycle to get all of that produced. So I get lots of pushbacks that it's not going to happen. Our view is going to happen. The question is what the valuation you're willing to pay for that. For us, in the space of European equities being an overweight in the global context, it's a neutral right now. But I believe it's something you want to have, and I do know that many asset allocators, for many reasons, still don't hold these stocks. So volatility possible for the entire market as well, but I know that we many investors buying the dips there, right?
Yeah, muscle memory on both sides, quite hard to deal with. Beata, thank you very much indeed. Nice to see you. Beata Menthi, European Equity Strategist Head over at Citi. The Core 6 looks like this morning. Let's walk you through what we're seeing in terms of the numbers. You are obviously seeing a fairly quiet market, you could argue, and you're certainly seeing that on the screen in front of us as we head towards the US payroll number a little bit later on. There are some single names that are moving. You are seeing pharma doing better than luxury. Luxury is maybe back to flat, but this is not a market, I think, this morning with a clear sense of direction, Lizzy.
Well, next up, we're going to go to Switzerland. UBS set to be told it may need to put aside as much as $25 billion against future losses. So we'll dig into the capital conundrum that faces Switzerland's biggest bank. That's next. This is Bloomberg.
Let's call it 17 minutes into the session, we need to deal with the bottom-up news, which basically takes us this morning to Lululemon, which got dinged up pretty badly overnight after posting its numbers, signalling that tariffs are having an impact. You're seeing that coming through into, I'm never sure of the word athleisure, but we're going to use it this morning. The athleisure stocks, Adidas, Puma, JD Sport here in the UK. And as you can see, these stocks are down. They're actually bouncing a little off their lows right now. It took a while for them to get going, but they are definitely under a little bit of pressure after we saw that warning coming through from Lululemon. Tariffs are having an impact, and it is certainly impacting that stock, which rips through into European stocks this morning.
Yeah.
You got wind stocks.
Wind stocks blowing a bit more positively this morning. Vestas up 4.3%. This again comes back to Trump policy and the clarity perhaps that's coming on the big beautiful bill. You've had a note out from Martin Wilkie over at Citi saying that that policy clarity could come soon. It would support Vestas's outlook through 2028. You've got billions of dollars in incentives for the wind industry and the clean energy groups on this absolute lobbying blitz. So this could be putting the wind in the sails, shall we say.
But doesn't that require the big beautiful bill to pass? And isn't that thrown into jeopardy
by
Elon Musk yesterday?
Perhaps, and maybe Wilkie's note came before all of that, but maybe they'll kiss and make up and wind will get away with it.
Apparently there is a kiss and make up call scheduled for a little bit later. The Swiss government will propose a bill to Parliament today that could force UBS to maintain as much as $25 billion in extra capital to protect against possible losses in its foreign units. The company's CEO, the bank's CEO, Sergio Motti, says the demand could leave Switzerland's biggest bank at a huge disadvantage to its peers.
UBS is in a high-stakes showdown with Switzerland. The assets of the world's biggest wealth manager are twice the size of the Swiss economy, stoking fears among officials that a banking crisis like the one that brought down Credit Suisse would be all but impossible to control. So, Swiss lawmakers want UBS to boost its reserves to protect against 100% of any losses at its foreign units. The extra capital required could reach $25 billion. But CEO Sergio Motti says the plan would put UBS at a major disadvantage with peers. It could take until 2029 for any law to come into force, but UBS may not wait that long. Measures being considered even include moving its headquarters out of Switzerland. However remote, it's a possible scenario that will surely catch the attention of lawmakers in the Swiss capital, Bern.
Just trying to work out why the trams were red. Now I understand a little bit more. OK, let's bring in Tom Metcalf to figure out exactly what we are talking about here. So how is this going to play out today? How big a day is this in this road towards potentially higher capital rules?
Yeah, it's certainly like the first really big set piece in what's probably going to be a multi-year kind of, let's say, discussion between UBS and the Swiss government. So expecting sometime this afternoon, the Swiss government will sort of formally lay out at least its initial proposal. And our reporting suggests they're going to go literally the sort of full-fat version, the worst possible scenario for UBS, which is that 100% capital sort of reserve against its foreign subsidiaries, that sort of $25 billion hit. And then, of course, the thing that's kind of expected, and what will be really interesting to watch, and I think should be the focus, is what is UBS's body language to this announcement. They're kind of expecting it to happen. How aggressive do they go? Are they sort of going to play the long game? Because, as that report just pointed out, this is not going to happen tomorrow. This is going to happen, at the earliest in probably 2027, if not after.
So realistically, if it is the full-fat version, how damaging is it to UBS's business, and how realistic is it that they would, move their headquarters out of Switzerland if you're saying that they're not going to, retaliate immediately?
Well, certainly, yeah. I mean, I think, it's kind of the negotiation. It makes much more sense. They certainly wouldn't want to do anything drastic if they can. But I think, let's say it does go through, as the Swiss government currently say, and I do think that's unlikely. But if you're facing a $25 billion hit as a bank, you're going to have to make some changes. And, just from, speculating, right? Like, it's against the foreign subsidiaries, so do they do something to try and minimise that hit by changing the structure of the bank, perhaps? But it's really fascinating watching this sort of debate play out, and you can understand why UBS are, kind of considering even the most extreme versions, because obviously, perhaps that helps them get some leverage with the government, because I imagine the Swiss government doesn't want to see its biggest bank completely disappear.
Yeah, but it is big, so it is a problem vis-a-vis GDP. But the key thing here is that other jurisdictions are not proceeding at the moment with the latest Basel legislation. And that's so the European Union is waiting for the US to react, the UK kind of in a similar position as well. So other jurisdictions are not at this point imposing such onerous requirements on their institutions and may never impose such onerous. So how different is Switzerland in terms of its approach vis-a-vis the other banks and the other jurisdictions? Context is important here.
No, and I think Switzerland is the outlier there. They are certainly on the regulatory side, seemingly, in terms of what they're saying, the most aggressive. So, as you say, the UK, EU, they're all delaying various Basel rules in a bid because everyone needs to know what the US is doing, because, UK banks, EU banks are freaking out that, hey, if the US goes very lax or easy, we're going to be at a massive disadvantage. But so far, at least, Switzerland has sort of struck the sort of most stringent tone and said, no, we're going to move ahead, we're trying to apply for this. And that reflects to this situation as well. Like, from them, as you say, UBS absolutely gigantic. They're in kind of this unique position.
But Credit Suisse is still fresh memory.
Yeah, exactly. So there's a lot of scars from that. Yeah. And so it's understandable, but I think you'd be pretty frustrated if you're a Swiss banker, at least.
While we've got you, can we talk about HSBC? The chairman, Mark Tucker, leaving. What does it mean for HSBC?
Yes, intriguing. He's going back to AIA. He's going to chair it there. I think for me, just how quickly this has sort of developed. So last month, they flagged he would be leaving by the end of 2025. And, normally these situations, it runs right through to that time frame. So the fact he's going to be leaving at the end of September to take on this new job shows, I think he wasn't hanging around and obviously found this plum job that he's keen to take. And for me, the big question now is, HSBC have this hiring process ongoing. Who do they find? Is it an internal candidate? Is it an external candidate? And that's the most interesting thing, to see what names start floating around, and can they move quickly enough to get someone in place by October the 1st, or will they keep an interim chair in place for that a little bit longer?
OK. Well, the shares are up a little bit this morning, 0.3% for HSBC here in London. Bloomberg's Tom Metcalf, we thank you. All the latest in banking. Let's turn now to central banking. President Christine Lagarde says that the European Central Bank is coming to the end of its campaign of interest rate cuts following the 8th reduction in a year yesterday. With the Eurozone suffering repeated blows from US tariffs, the deposit rate was lowered by a quarter point to 2% amid all of the tariff uncertainty.
Higher tariffs and a stronger euro are expected to make it harder for firms to export. High uncertainty is expected to weigh on investment, but at the same time, several factors are keeping the economy resilient and should support growth over the medium term.
So hawkish message, more hawkish than we were expected. Traders paring bets on future cuts. But the other thing that happened, of course, was the furious denial that Christine Lagarde's going to leave and go to the World Economic Forum.
Yeah, that had been floating around for a little while. It did seem a little odd, and it's interesting that she came out so strongly and has basically said, no, I'm going to serve through to the end of my term.
That's all she said. She's determined to serve the term. She didn't outright deny it, I should say.
No, that is true. She's going to, but I think we can now move forward from here that she is going to be sticking around, which takes you on to the kind of the policy question and takes you on to the personality question. Why was the statement and the press conference so different? Is the statement a reflection of the governing council? Is the press conference more of her interpretation of it? It's interesting that sometimes you get this with Powell and the FOMC as well. Why the difference? Why was she so hawkish? Because I read the statement, I saw the statement yesterday, I was like, that sounds quite dovish.
Yeah.
And then you get the press conference, which wasn't. Why?
Well, actually, don't you think that supports the argument that maybe she is contemplating moving over to the WEF because job's done on the euro area economy?
I think that is a stretch to make that argument. But I'm wondering why the governing council does seem reasonably divided at this point. Is she putting an interpretation on the outcome of the meeting? Why was the statement as dovish as it was? And did she feel a need to correct that? I don't know why you end up with these slightly different, because it did catch the market by surprise when she came out with some of those more hawkish lines. The market basically had been put to sleep by the statement, which felt like it was a nothing, and then you got a something. And I'm wondering why you got a something.
Well, speaking of the divisions on the Governing Council, it was the first non-unanimous cut. And we're going to dive into what's actually happening on the Governing Council. We're going to have an exclusive conversation with Greece's long-serving central bank governor, Yanis Stournaras. That's coming up next on the programme, so do stay with us. This is Bloomberg.
Good morning. Welcome back. 1:30. We are 30 minutes into today's equity session. As you can see, equity markets aren't going anywhere in a hurry. The reason for that, probably we are waiting for the non-farm payroll number to come out of the United States a little bit later on. The survey number points us to somewhere in the 120s. The Whisper number points us somewhere in the 110s. The Bloomberg Economics estimate points us somewhere towards 90. Are we set up for a weak number? So that's what the macro picture is going to be all about today. Yesterday, though, it was all about, of course, what we got from the ECB. The central bank lowering rates for an eighth time, inflation dipping below 2%. We know all that. We did, though, get a slightly more hawkish press conference than maybe some of us had been led to believe by the statements that we got out from the Governing Council. So let's try and clear up what is happening here. We have an exclusive interview with Greece's long-serving central bank governor, Yanis Stournaras. Very nice to see you.
Morning. Very nice to meet you too.
You and I first met during the Greek financial crisis, which seems like such a long time ago, and the country's come such a long way since then. We'll come back to that in just a moment, but I want to get your take on what happened yesterday, first of all.
Well, it was an expected decision, I think.
It was an expected, okay.
Yes. I think we have achieved what we can call soft landing in a difficult world situation. So inflation now is 1.9%. Our medium-term forecast is close to 2%. So we have cut. Now interest rates are at 2%. We have cut 8 times in the last year.
The question is now what? So
now what? I think now the best thing is wait and see. As we know, we are now data dependent.
So you're not necessarily done. So, because the question going around this morning is the ECB done?
It is nearly done.
Nearly done.
But with such uncertainty worldwide, you can never say that it is done because we have tariffs, we have geopolitical tensions. So we are very, very careful.
So maybe another cut. What kind of data would you need to see to trigger another cut?
Well, if the economy weakens more, if inflation falls in the medium term sustainably below 2%, then we might cut. But this is not expected. I mean, we have our new forecast. We are confident. But of course, it's, we are data dependent.
I mean, a lot of people were thinking about July. Now people are more thinking about September for the next cut. Do you think that there's inherently a problem for the market getting confused if it's a long pause between...
No. I mean, if you remember, I have talked about a pause for a long time now. And so it's not something unexpected. And, well, our forecast is that there are risks, there are downside risks to growth. On inflation, we are more balanced. So we are quite confident about our forecast now. So wait and see. We are keeping options open, meeting by meeting, data dependent.
There seems to be some surprise at the statement yesterday, which kind of appeared quite dovish, and Christine Lagarde's press conference, which seemed to be a little bit more hawkish. Is that kind of... was there any difference between the two? Were you surprised by how hawkish Christine was yesterday?
No, because perhaps this time the difference between what you call dovish and hawkish is not that big. I think we have converged. There was almost unanimous decision yesterday. I mean, it was not surprising that Christine said that, the president said that we are nearly there. And if we are nearly there, the best thing is wait and see.
Okay, so
she did not exclude anything, in my view.
Okay, fair enough.
Yeah.
There's a lot about to happen. We don't know what's going to happen with tariffs.
Absolutely.
We don't know what's going to happen with economic data. We still haven't seen evidence of a tariff impact, particularly into the US economy. We haven't certainly seen it in maybe some of the data we're seeing into the European economy. What's your degree of certainty right now? You talk about kind of there are lots of different options, but how can you quantify? Is it possible to quantify the degree of uncertainty?
Well, we tried in our 3 scenarios yesterday, the baseline, the mild and the severe. The differences are not that big. That's why we are quite confident about our forecast and about our stance. But I fully agree with you.
If they're not that big, then the degree of certainty is quite high.
It is quite high. Yes, it is quite high. And it is not only tariffs, it's the bond market worldwide. There are mismatches of demand and supply. So the bond market worldwide is also something that we should look at. But you're absolutely right. With the introduction of a tariff war, things have changed dramatically in the world economy and in the euro economy. The big picture is that, at least for Europe, the effect of tariffs is deflationary. For the United States, if I can say, it's stagflationary. So there's a difference here.
But Governor, in those...
which complicates monetary policy.
In those scenarios yesterday, even in the most severe scenario, you didn't see US tariffs on the EU going up to 50%, back to 50%. What if that happens?
No, the severe scenario is not 50%, it's a bit less.
Exactly.
It's less.
But what if it is, let's say, very severe, and it's 50% and the EU retaliates?
If it's very severe, that means the effect on demand will be even harder, so more deflationary. If it's a retaliation, I don't think that Europe will retaliate horizontally, but in specific sectors. But I don't expect that, to be honest. I think at the end of the day, things will normalize, because I think, first of all, it is in America's interest not to have tariffs. If I can give my advice, 0 for 0 is the best. The best for America and the best for the world.
But what about China in this equation? Because I heard a few thinly veiled references from President Lagarde yesterday to essentially China dumping. If that happens, or what level of US tariffs would really need to concern you about the deflationary impact of China dumping on the euro area?
Well, you already know that the effect of tariffs, as I said, in Europe is deflationary, highly deflationary. the higher the tariffs that America imposes, especially on China, the higher the risk that China will try to substitute the American market for other markets, and especially Europe, because European consumption is the second biggest in the world after the US's. So it's likely that China will try to sell its products to Europe. So it means more deflation in Europe.
I mean, are you worried about deflation? I mean, you know, the new 2026 inflation forecast is 1.6%. Are you concerned that actually there's a persistent undershooting of the inflation target?
We think that it will come back to 2%. Energy prices will help here. The CO2 emission tax will help bringing inflation back to 2%. So yes, for 2026 we have 1.6%, but for 2027 we have 2%. So in the target. But of course, this is a forecast.
Are you surprised? The euro's got stronger as you've been cutting, which seems slightly contradictory if you kind of think about it from an interest rate point of view. The US hasn't been cutting, well, it's cut a little bit, and the ECB's cut more. In theory, the euro should have gone down, but it's gone up. What do you think is going on here? Do you think we are seeing an end to the dollar's exceptionalism, its role as a world currency? Do you think the ECB, the euro, has the potential to fill some of that gap left?
First of all, nobody is happy about what's going on in economic policy and trade policy in the United States. But if it continues, I'm afraid the dollar will lose some of its status. Not automatically, of course, not overnight. It will take time. So the euro will not become automatically a substitute for the dollar. It will take time. But also, Europe needs to act. It needs to complete its banking union, to complete its capital union, to consolidate even more its public finances. But I think the prospect for the euro is better now.
Do you worry about the impact of a strong euro on Greek exports? I'm thinking about tourism.
Well, we have to take into account everything. We talk about a general equilibrium situation. So, okay, a strong euro is bad for exports, but also it's good for other things. The financing of our public debt, for instance, because there is now a reversal of capital flows. Up to 6 months ago, it was money flowing out of Europe to the United States. Now it's coming back.
Final quick question on the financial sector. Greek banks are in focus at the moment. There is interest in Greek banks once again. I take us back to the beginning of our conversation.
Does it surprise you?
No, it doesn't. No, it doesn't surprise me. But in some ways, you could argue Greece has come a long way back, and the fact that we are now talking
it has actually.
Greece is people being interested. So UniCredit is now interested in taking stakes in Greek banks. Do you welcome? Are you on the side of cross-border takeovers? Do you believe?
Yes, strongly, and for many years now. When I was governor of a commercial bank in Greece, I had invited a cross-border transaction, and Crédit Agricole became a shareholder. So I'm very happy that we are now continuing this policy of cross-border transactions.
So we have welcomed being taken over?
Both the government and the supervisor of the Bank of Greece, we have welcomed UniCredit in Greece.
Others are taking a different view in different countries.
Yeah. I'm sorry about that.
Yeah, this is great to see you. Thank you very much indeed for coming to
You're welcome.
Thank you. Appreciate it.
Thanks a lot.
The Bank of Greece Governor, Stournaras, joining us around the table this morning. Up next, we're going to take the conversation in a very different direction, I can assure you. We are going to tap in, and it is Friday, to the world of non-alcoholic beers. The Carlsberg CEO is going to be joining us next to discuss. That conversation is coming up. This is Bloomberg. Morning, folks. Welcome back. Friday morning. We are 45 minutes into the equity market session. European equities, I hate to say it, are going nowhere in a hurry. So we shall look for a buzz elsewhere. And this time we are going to look for it in the beer market, particularly the non-alcoholic beer market. A new forecast from IWSR, which I have no idea what that is, but we'll come back to that in a moment, suggests that the booze-free beverage market is set to overtake ale as the second largest beer category by volume this year. So it's something that we should be talking about. Carlsberg's CEO, Aarup-Andersen, and Bloomberg's food editor, Kate Crader, joining us around the table this morning. Welcome both. Good morning. Lovely to see you in London.
Good to see you.
Stopping by to see us.
Of course.
This is structural, right? This isn't just a fad. This is a shift that is taking place within your market. It is an opportunity. It is a big change, but it is an opportunity.
We think it's a massive opportunity, and you're spot on, Guy. It is structural. So what we're seeing is quarter in, quarter out, we're seeing the highest growth rates coming from alcohol-free. This quarter we just reported, we had 15% year-on-year growth in alcohol-free beer. And we do continue to expect that alcohol-free beer will be the highest growing segment within our categories.
In terms of, therefore, how your business changes, what does Carlsberg look like in 5 years, 10 years' time? How do you think this is going to evolve?
Well, we think the overall moderation wave as such has a great momentum. And that's also why when we've been structurally allocating our capital, we've over the last couple of years also done significant acquisitions within the non-alcoholic sector. So we did a massive acquisition of Britvic here in the UK within soft drinks. And when you look at our footprint today, already a third of our entire business is soft drinks. We have non-alcoholic beers growing fast. So I think when you look 5, 10 years out, you're going to see a business that is much more balanced towards alcohol versus non-alcohol. And for us, that's a great development.
But isn't it a societal shift? Like, what does your sales data teach us about the non-alcoholic movement, the teetotal movement? Because, you tend to think that it's Gen Z that's converting, but surely you have growth markets in the Middle East. It's a massive opportunity there.
So the data is incredibly exciting because I fully buy into what you're saying in terms of the overall feeling around what this movement is. But actually, I think the most interesting data point is we're seeing as much growth and penetration of alcohol-free beer across all generations. I think that's the first important point. The other element is we're seeing it especially, as you say, Middle East is a growth market, but so is Western and Central and Eastern Europe. It is a growth market in alcohol-free beer. Asia less so, but we think that will come. So moderation as a theme is a theme that's here to stay. But alcohol-free beer gives people that ability to also do what we call zebra striping, which basically means that they move in and out of alcoholic beers and alcohol-free. And I think that's the most important data and insight. That is 80% of the people who drink alcohol-free beer, they also drink alcoholic beers. So they use it more to moderate than staying teetotal.
OK, that's interesting. Kate, it's something that you've been covering a lot.
Yeah, but I was going to say it's still like a small fraction. It's only about 2% of the overall beer consumption category,
Correct.
Isn't it?
Yep.
So where do you see opportunity to push it even farther? Like, will you go to football stadiums? Do you see more opportunity with, Gen Z is obviously a huge consumer of it. Where do you see the most opportunity going forward?
So I think you're spot on. What we're seeing right now is the curve has been increasing, and I think it's going a bit more exponential in some areas. Also because we as an industry, we're embracing this. We don't see this as a challenge. As you said, Guy, we see it as a real opportunity. We don't necessarily wake up in the morning and we have to sell alcohol to you. We want to sell you a beverage that suits the occasion that you have. And if you look at it, the big festivals in Europe this summer, where we sponsor many of them, you're going to see much more the non-alcoholic choice next to the alcoholic choice. We're actually doing at the biggest festival in Northern Europe, Roskilde, we're doing zebra striping, which basically means you get zebra striped 6-packs of beers that are alcoholic, non-alcoholic, etc.
What, like roulette?
Yeah, no, exactly. Well, you know what's in it. So I hope you're sober enough to
understand. One to the other. No, which one am I going to pick?
Thank you for that. And you will see at all the big festivals in Europe, we will have a day beer and a night beer as well. So a non-alcoholic for day and an alcoholic for night. So there's a lot of initiatives going on here, and so I think it's just the beginning of the wave.
Kate, how do you see this developing? I guess, is taste getting better? Does the product taste better? Does it need to taste better? What needs to happen to keep it going?
It's such a good question, because I think that's where a lot of people stop. They've had bad taste experiences with NA beer in the past, and so they'll do it just because because it's the daytime, because it's 10 o'clock in the morning in the airport, right? And you think, I can't really have a beer in good conscience. So
clearly, I've met some of my friends, but okay.
Well, we'll talk to them later.
Yeah.
But I think I think that once someone has one and it tastes good, and they're like, oh, this actually isn't so bad, it doesn't taste like bad water, then all of a sudden people adapt farther. But I think that is like the biggest, I would think that's the biggest.
Is the flavour developing?
I think Kate is spot on. So if you look at the last 5-10 years, the development of flavors and taste, it's just exploded. So I fully agree. If you go back 10-15 years, a non-alcoholic beer was not a great taste experience. It was almost a punishment. If you're there today, many of the great brands, ours and our competitors, great brands in non-alcoholic, you can hardly taste any difference. And there's a lot of award-winning non-alcoholic beers coming through. So I think you're right. It's a completely new category. It's opening up new occasions. It's also bringing in new drinkers who would not be drinking beer but just enjoy the non-alcoholic beverage.
Can I tell you, as the person around this table who doesn't drink, do you know what I drink? Water. Are you not afraid of the teetotal movement? I know it doesn't make
the business
money.
model isn't going to work.
I get it. Surely you don't want this movement to take off, even though you're kind of encouraging it with non-alcoholic beer.
So, actually, I disagree. So I hear you on that. Water is a great tasting liquid, though.
Keeps you hydrated.
Yeah, no, it keeps you hydrated. So exactly. But we do see globally, if we look at it from a company perspective, we see globally that packaged drinks is a constantly structurally increasing segment. So, but people are moving between different types of categories. So yes, there is a moderation going on. You do see mainstream core beer being under pressure, but we see strong growth in premium beer, strong growth in non-alcoholic, etc. And soft drinks is a very, very fast-growing segment. People will drink a non-alcoholic beer not just for the hydration, but for the great taste, for the food pairing, and all of those things as well.
Do you see, are you, in fact, as you say, like the category is getting so big, so Athletic Brewing Company is coming in. That's a big U.S. brand that has made a big splash here, so to speak. Do you see a lot of competition from them? Are you worried about them? Are you learning anything from what they're doing?
Listen, we've done this for 178 years, and there's always been new competitors coming in. I think one of the reasons why we have the size and the scale and the breadth we have today is we have that ability to constantly innovate. Of course, we look at, I'm not going to talk specifically around those guys, but we look at everything that's coming through. We have a lot of innovations ourselves. It's important for us to constantly make sure that we're relevant for the consumer also the next 5-10 years. So we're testing a lot of concepts and innovations all the time. There's no doubt that the category and the industry is developing very fast, but it has been for many years. And I think that's just what big scalable companies like us, that's what we do. We constantly adapt.
In some ways, I just want to come back to Lizzy's point about water. Water is generally, if it comes out of the tap, fairly free. You can buy it. It does cost more. But prices, I'm really... One thing that always kind of surprises me about this segment is that it basically... I can have a pint of alcoholic beer and I can have a pint of non-alcoholic beer. They're basically going to cost me the same thing.
Exactly.
Right.
And I'm wondering how... is that something that is impeding this segment, or in some ways continuing, because it just continues the narrative that that there's no difference?
I mean, I think you're the person to answer that question, but I would say from my point of view, from a consumer point of view, I think at that level, if the beer costs the same, you think they're doing something special to it. I think there's actually resistance when an NA cocktail costs the same, costs like, 18 pounds or 20 pounds, and you're like, what is going on here? But with beer, I think the price point is such that people will say, oh, they're putting some effort. However, they're de-alcoholizing it is working. So but how do you see it?
But I think you're spot on. So if you look at the technology that goes into brewing non-alcoholic beers, it's a very complicated process. And
is it more expensive to produce a litre of non-alcoholic beer than alcoholic beer?
It's a tough comparison, but it's definitely not cheaper. It really depends on the brand, et cetera, et cetera. But especially if you look at some of our best-selling non-alcoholic brands, there's a lot of craft that goes into this, and there's a lot of added ingredients to also mimic the alcoholic elements that are important in terms of the taste experience, etc. So it is a very complicated process, and that's also why the quality of the non-alcoholic beers have gone up so much over the last years. So I think our consumers, if you look at the growth rates, our consumers are definitely not saying the price point is the wrong price point, but they are saying that this is a super exciting proposition when you look at the growth rates. So you have classic mainstream core beer in the industry is basically flattening in Western markets, non-alcoholic growing double-digit. I think that says something around the fact that the price point is not the issue.
Just finally, Guy asked about prices. We've got to talk about how the trade war is impacting you. I know that you have a different kind of exposure, but are you going to have to raise prices?
So first of all, I would not announce price increases live on TV. Then my lawyers would have an issue with me.
Feel free.
Exactly. No, but if you look at it more generically, so of course, trade wars, it's not good for anyone when you're doing business and you're a global company. We operate in 150 countries. Our U.S. exposure is very small, and therefore we don't get a lot of direct exposure.
China exposure, though.
But we have China exposure, and what we get is the indirect exposure. So we are a consumer goods company. We basically, our heartbeat is the global consumer, and the global consumer is being impacted if this continues over the coming years. So we're, of course, hoping for a stabilization in the turmoil we've seen recently, because, of course, it will impact consumer sentiment and hit us as a consumer goods company. But it's not a direct impact, it's more an indirect impact.
We're going to leave it there. Great.
Thank you.
Thanks for it's a genuinely fascinating conversation. And as a parent of teenage children as well, it's fascinating to see how they are adapting to it as well. Carlsberg CEO, Aarup-Andersen, thank you very much indeed. And Kate, great to see you. Thanks for stopping by. Kate Crader joining us around the table. It is the weekend, which is the perfect kind of jumping off point from the conversation we've just had. Big weekend of tennis coming up. I think it's... What? No! That's the wrong reaction. So I think you've got Queens this weekend. I think you've also got...
Beyonce in London.
OK.
Ludovic Subran is a fan of Beyonce, as I learned on LinkedIn. A guest of ours earlier in the week.
OK. Anyway, there's also some great coverage coming up on Bloomberg Weekend as well. Have a fantastic weekend, everybody. Hope you enjoyed the show. This is Bloomberg.